And joining us to reflect on the weekend markets and a closer look on what's currently playing itself out on that market scene is Muhammed Wagley from Sasfin Waealth. Muhammed, always a pleasure. Hello.
Hi, Nolitanda. Thanks for having me.
Fantastic, Muhammed. Okay, let's look at the start to the week. It's very hard to get a sense of direction at this time. I'm keen just to get your thoughts on what might be driving investors today.
So I think you nailed it a bit earlier when you said we had Sona and then boo, the lights went off. That was pretty much it. Now, to put it into context, so including today where we're slightly down, obviously it hasn't finished, we're down pretty much 9 of the last 11 days, and when you contrast that to sort of the respite that we've seen offshore with global markets pretty much flying, it paints sort of a bleak picture, and really that's kind of the direction we're heading in. When we look sort of for guidance, I suppose, all the pressure on and all the eyes on Mr. Gorongwana's budget speech on the 21st of Feb. I think that's really what we're going to be keeping an eye out for, and I suppose good news on that front would put us in better stead going forward. But let's see, keeping my fingers crossed, but not too optimistic, truth be told.
Also keen to then find out that rand we're seeing there over the 19 to the dollar mark. That all of that is a sign of course, what we are seeing in the United States versus here at home, or is it also pricing in boom, the lights out?
Yeah, I think there's a bit of that. Truth be told, I think it's got to do sort of with more offshore factors. The load shedding is not a new issue. Most of that has been priced in. And, that unfortunately, sort of the long-term trend is every 10 years or so, we double against the dollar, and that looks likely to continue. As I speak, I suppose you'd have noticed the load shedding in the room there.
Now, I'm keen to also just look abroad there to the US. We are expecting US inflation data out this week. What are we anticipating here? It's been a very hot and cold picture. The job numbers are strong. Other indicators showing that we're on the right track, Mohammed.
I suppose the key thing is always bringing it back to inflation and what the Fed are going to do with the rate cuts. So ideally we're hoping to see it hold up a little bit better. With reference to the last numbers, they came out sort of a bit weaker than was expected. So we're keen to see sort of what numbers come out and how that could play out relevant sort of to the FOMC meetings, which we'll see in the next month. That's really the key thing. How is this going to impact interest rates, and how long can we sort of persist with the higher for longer narrative?
Also this week, we are expecting numbers to come out of NVIDIA. Now, that's a big one, right? Because NVIDIA is NVIDIA. And we saw in 2023 that it's a kind of company that can really outdo even our expectations. I'm keen to get what the thoughts might be there for now.
Interesting. So I'll also be keeping an eye out for this one. So really last year, NVIDIA were the pretty much only gaming town. Like very briefly and very simply put, they were the ones creating sort of microchips that had the AI functionality. For the longest time, they were the only ones doing this. As I understand it, Intel and AMD have come to market. So I think what will be Microsoft as well, if I'm not mistaken. So we'll be looking to get an idea of how much of that market share NVIDIA still retains and what that outlook is going to look like going forward. Personally, I'm still quite positive of the company. I just think they're way ahead of everyone else. But I suppose we'll have to keep an eye out for the numbers and perhaps revert. I think really the story here is the company's done, 250 odd percent since last year. And I think the question is, should we be looking to maybe trim some of that? Should we be looking to get out? I think we'll see a bit more guidance come out in the numbers tomorrow, but I'm not really panicking here, not at all.
Let's also touch on oil, Mohammed. We saw last week, I think, oil making about 6% gains. I'm wondering if there's something to look out for as we continue to watch our global inflation picture. And what is driving what we're seeing with oil right now? Of course, we know OPEC plus countries are more likely to welcome this, but for the rest of us, this gives us more inflation jitters.
Yeah, no, absolutely, and funny enough, Sasol also came out with results, I think it was on Friday, really, and they pointed sort of to that price putting a bit of pressure on them, just with reference to the increase that we saw last week. In my view, I reckon that's got to be sort of just weak basis. But that being said, that was really the view for this year. We had seen it come off. I think probably the last time I was on, we were talking at oil about like 78 odd, so it has sort of rallied, really. And that's really on the basis of low basis. In terms of like a sustained rally, I'm a bit more uncertain in that regard. But I must note that quite a few commodity bulls around me, not just oil, but gold as well. So definitely something to keep an eye out for there. But I suppose I'm not as bullish maybe as those around the office.
Let's also talk on the UK. Now, that's also a part of the world that has experienced more weakness than I think many of us have seen in quite a few generations, Muhammad. But of course, this week we are expecting jobs data, inflation data, growth data to come out of there. What are we anticipating for this economy?
Look, I'm not expecting them to really shoot the lights out in terms of growth, but I do expect the economy to be showing a little bit more sort of resilience. I think that's really what we're expecting. But what I must note, just in terms of sort of the UK economy, I think there's a bit of a misnomer. We contrast it a bit to the US economy, which is very tech heavy, and much has been made of Magnificent Seven. You don't actually find those types of companies in the UK. You find a lot of legacy businesses on that stock exchange, and I suppose in that sense a bit more comparable to our market than it is to the States. But that being said, they've got quite a few things going for them that we don't. And I do expect to see a bit of resilience there in that regard. So yeah, let's keep an eye out for the numbers. And again, these numbers are completely linked to those interest rates. I suppose that's where it's relevant. So we're looking to see a bit of strength there, and then perhaps the central bank can start to look at cutting rates a little bit sooner. But let's see what happens. I don't think that is going to happen, but I suppose let's see.
Also, want to stay in Europe. I want to touch on what we're seeing in Germany there. That economy seems to be struggling. It is Europe's biggest one, and so I'm wondering if that has a bearing at all on what we might then see throughout that region. Mohammed, are we expecting the EU just to fare a little weaker than, the UK, for instance, but even itself?
It's a good question. Look, the outlook going into this year was that global markets were going to be sort of improving, and needless to say, that's really coming off low bases. We're not sort of, or I suppose we're facing the turmoil that we faced last year, but obviously sort of to a lesser extent. So it computes that we'll sort of see a rebound. To answer your question, relative to the UK, I expect to see a bit more growth there, despite the fact that we are seeing a bit of weakness, specifically within the context of Germany, as you mentioned. That is the biggest market over there. It's definitely going to have an impact, but I'm still expecting to see sort of somewhat robust single-digit growth this year. So yeah, let's see. We sort of wait and watch. We kind of need the growth, so I guess fingers crossed, hoping for the best here, but my view is quite positive.
Well, Mohammed, I'd like to get your stock pick, but first let's reflect on some counters that have found favor with your industry peers.
I'm going with Italta. So they have a vertically integrated tile manufacturing and tile glue manufacturing. I think it's probably fallen quite a bit. It's probably down 60%. And my belief is that, it's been a business that's proven to be resilient. It's if you look at what is called the home improvement retail in South Africa, in the last 10 years, that segment of the economy has grown at about 10% per annum. And if you go 20 years, it's grown even at around 15%. It's an area of resilience. It's where people are trying to invest in their own homes. And this business has fallen quite a lot because of their last result, particularly. I do think that it's an opportunity where it is at the current level.
So I'm going for another South African small cap business. This is Argent, but predominantly a business of manufacturing, commodity trading interest in SA, UK, and a little bit of the United States as well. Similar to Invicta, it's got quite a nice offshore component. So if you look at the last interim results, 75% of the profits actually came from those offshore ventures. So it makes it quite a good rand hedge. Also, the fuels business, which is predominantly in the UK, has got a very healthy order book, and it's got very, very high barriers to entry. So we like that business. We think there's a lot of potential there. But why I also like it specifically is the valuation. Business trading at a P of less than 4, less than half a book value. Got dividend yield of more than 6%. However, it only pays out less than a quarter of its earnings, so that huge upside there. Free cash flow yield region of 25%, strong balance sheet, high net cash component of market cap region of 25%. And they're doing share buybacks. They bought about 20% of the shares back there last year. We also saw an update from, I think this week, where they sold one of their properties and as a result bought back more shares. So this is a classic example of a business that is completely forgotten by the market, and it's ridiculously cheap. Happens to be listed in South Africa, even though most of its ventures offshore. I think there's also going to be more value unlocked as they sell more assets, so forth. So we really like it. We think it's an excellent opportunity, and investors should be looking to pile in.
Today, I have to go with one of the Magnificent Seven. Microsoft is my pick today. Microsoft has been having a great run last year. However, last week they also released their results showing great growth, showing about 18% in revenue and net income 33%. And this is after they absorbed Activision Blizzard. So this brings in the gaming side of the business, it brings everything under one roof. So I do believe that Microsoft has a much more promising future going forward, and that's why they're my choice. Even though the PE ratio is quite high, that's why they're my choice.
All right, Muhammad, keen to get your thoughts on some of those counters. It's Telltale, Argent, and Microsoft.
Quite a contrast this week, Noluthando. So we've got Telltale and Argent. I think, those are quite small cap companies. They did mention it. I think Argent's just worth sort of $1 billion in terms of market cap. And then we've got the biggest company in the world in Microsoft. So quite interesting. Let's start with those two local companies, Telltale and Argent. Telltale's actually, I have actually followed this company, quite a good business. I think there's sort of good value to be had here. Really, the issues that are plaguing the company are sort of, the issues that we're seeing here locally. They're sort of hamstrung by weak local consumers. But it must be said, there's really decent value to be had here. I think just the one thing to note is you've got to sort of be nimble with an exit strategy here. This isn't probably one that you're going to be holding for the next 5-10 years or so. But at current levels, it does represent decent value. Argent, I had to take this personally. I suppose I'm one of the investors on the local market that forgot about this one. It's a very small company, but I would say that your analysts there did paint quite a good picture. The story sounds good by and large. We've got a rand hedged company. They're buying back shares. They've got quite a bit of exposure in the UK, so it's good rand hedge exposure. But I must note again, this is a company with $1 billion market cap. I haven't seen any trades today. Chances are getting in and out might be a little bit difficult. Can't argue though that it does represent decent sort of value at these levels. But I could say that really sort of for most of the JSE. And then let's come to Microsoft. Great pick. I love the company. I would say this is more so for those of you that don't have exposure. You should be getting some. They've got great AI exposure, well diversified, pretty much across the board, and they've pretty much got exposure to tech across the board. It's Microsoft. You really can't go wrong. That's the truth of it.
And with that said, which counter are you loving today?
I'm loving Ferrari today.
Okay.
So luxury company numbers came out last week, and whether it was Hermes, Richemont, Louis Vuitton, or Ferrari, we pretty much saw great growth across the board. Now, in my mind, this is a case of, some things change, but some things very much remain the same. Now, despite all of the sort of economic pressures and unrest that we're seeing, companies like these cater to those super ultra high net worth individuals who can sort of still maintain a huge demand for these products. They continue to buy the products at higher rates than they were previously. We're even seeing sort of price increases on these products, and these types of consumers manage to stomach them really quite easily. So in that regard, my pick in this space is Ferrari, not just because Lewis Hamilton has joined them, but really sort of company specifics. The core business is going to sort of keep growing. They've got a full order book stretching out into next year. By the end of 2025, we should also see the launch of the first fully electric car. And I suppose just in terms of why I'm picking this one over the others, which I also really like, and you should also get as well. But just relative to, let's say, Louis Vuitton and Hermes, they've just got a little less China exposure. In fact, they've got substantially less China exposure. We are seeing a little bit of a wobble in that economy. So on that basis, I'll go ahead and go with Ferrari.
Well, Muhammad, always a pleasure having you. Thank you so much for your time today and getting the week started off for us. That was your midday markets update with Muhammed Wagley from Sasfin Waealth.